So talking a little bit about some of the deadly mistakes that we often see in estate planning. And unfortunately, when do you usually find out that there was a mistake? Usually when it's too late. And, you know, we're dealing with a lot of that right now. A lot of unexpected because of the pandemic that we have. I will tell you that in the last few days, I have spoken with 2 clients that lost their father, and I personally lost my father just over 2 weeks ago. And it was a surprise, and it was COVID related. So I certainly can appreciate, as you lose a loved one, how difficult it can be on you and on your family. So it actually gives me a great satisfaction in my job to help individuals be prepared for those types of situations. So a couple of the common mistakes. First of all is no protection for living or death probate. We're going to talk a little bit about living probate a little bit more. Not keeping up with law changes. I can't tell you how often I sit down with somebody and they'll come in and they'll say, well, I haven't updated this for 10 years or 20 years. And unfortunately, it often defeats the purpose of what you have. No protection for nursing homes, or no protection to minimize taxes. And real quick on taxes, often people will say, well, I don't have to worry about estate taxes. Well, you may not now, but you could very shortly in the future. And there's other taxes that you will have to worry about. And those are income taxes and capital gains taxes, potentially on your surviving spouse and definitely on the beneficiary. So it's very important when we talk about taxes. It's a broad brush. Also, what happens if the surviving spouse decides to get remarried? Everybody says that will never happen. But I'm here to tell you, unfortunately, it happens very, very often. And it's not that getting remarried is bad. It's just, it's much better to plan for that contingent. Plan for that situation so that if it does happen, you're prepared and you're protected and you don't have to worry about assets going to different places. What about when you both pass and your beneficiaries are inheriting? What protections are in place there? Are there any protections? What if I'll tell you, one of the most common way for people to lose their inheritance is through divorce. Have you thought about what you can do to protect that? What if they claim bankruptcy? What if they get sued? There's a lot of options. Another big one, not creating or updating your healthcare directives. Especially if you've moved from out of state. Those are state-specific documents. Very, very important to make sure you have those up to date. And then the other thing is, does your family know what their responsibilities may be? Are they your executor or your successor trustee, or are they your healthcare agent? Make sure they understand and know those things. So we're going to talk about it a little bit more detail. First, we're going to talk about no protection between living probate and death probate. Living probate is, you may often instead hear it referred to as guardianship or conservatorship. But living probate is what we refer to when someone becomes incapacitated. And in this day and age, that happens. My father had dementia. So when he passed away, we had to do a lot to try and manage that scenario for my mom. But when you lose capacity, you have to be very careful to make sure you're prepared so that you don't have to, or your family doesn't have to rely on a court to give power or direction to sometimes even a third party. So it's very, very important that you're prepared for a living probate or incapacity of yourself, your loved ones, even your parents, if this is something you're talking about for them. And then death probate, of course, is something you've always heard about. When someone passes away with a will or with nothing, the court's definitely going to get involved. The other one is keeping up with law changes. We all know that our friends in Washington, D.C. never have anything to do. And often the things that they do tend to reach into your pockets and in my pockets and try to take whatever they can. And I'll give you an example. Yesterday, I was talking to a financial advisor and a CPA and a client about retirement accounts. The CPA and the financial advisor were unaware that in December of last year, the government, the Congress passed what's called the Secure Act. The Secure Act had a tremendous impact on what happens when your beneficiaries, not your spouse, but your beneficiaries, your kids, or anyone other than what's called a qualified designated beneficiary, which is basically anyone other than your spouse or a special needs beneficiary, things like that. So, or a minor beneficiary. So in those types of situations, you have to understand those new laws and how do they affect your plan and what things do you need to do to update to address those issues, because it could have a dramatic negative tax implication on your beneficiaries. So it's really, really important. In addition to Congress, sometimes there are court rulings that affect what happens. For example, if there was a Supreme Court ruling about 5 or 6 years ago that had to do with the protection of retirement accounts. So today, if one of you were to go and get in a car accident, and we often like to say rear end a school bus full of attorneys' kids, and like worst case known to man, right? But if that were to happen, they couldn't, and they sued you, they couldn't get to your retirement assets because they're protected. It's considered good public policy to protect those assets. It used to be assumed that when your children or your beneficiaries, again, other than your spouse, inherited those retirement assets, that same protection carried on to them. Well, unfortunately, there was a woman in Wisconsin that inherited a $400,000 retirement account from her mother. And 2 years later, her and her husband claimed bankruptcy. Her creditors, their creditors, went after that retirement account to get paid. Their defense was, you can't, it's a retirement account. And unfortunately, that case went all the way to the Supreme Court, and the US Supreme Court said unanimously, which you don't hear unanimous decisions very often, unanimously said that retirement accounts are, once they're inherited, are no longer protected assets. So that begs the question, how do we protect them? What can we do? So it's important to be aware of that. Estate tax law changes. I met with a client yesterday who had their estate plan, or their parents' estate plan was created in the mid to late 90s. The estate tax exemption at the time was $600,000. Today, that exemption is $11.58 million each between, if you're married, between each spouse. So you each get $11.58 million. Well, most of you will look at that and say, oh, well, I'm nowhere near that. I don't have to worry about it. Well, unfortunately, there are some things we have to worry about. And so we're going to talk more about that. But this is just an example of some of the law changes that have happened. And even if you look, there's several recently, and these are major, major changes. We talked about the Secure Act. There is a benefit for starting to take your required minimum distribution, but to be perfectly honest with you, the major thrust of that legislation was to force out the instead of your beneficiaries being able to stretch your retirement account over their life expectancy, which used to be the law, now they're forced to take that out over 10 years. And when they take that out over 10 years, it increases the size of those required minimum distributions, and then therefore increasing the taxes that your kids have to pay. So again, something very, very important to be aware of as you're talking about your plan and the taxes that your kids are going to pay. That is an income tax issue. So again, I just want to point out, I'm going through a lot here. If you guys have questions or anything like that, feel free to click the button to raise your hand, to type anything into the Q&A or the comment section. I'm happy to address those questions. So feel free. I want this to be helpful. Sometimes estate plans aren't reflected for life's changes. I have a client right now who adopted a grandchild because of a situation with their kids. Well, that changed their estate plan. And so they had to come in, and now when you adopt someone, legally they are considered your blood child. So they are a direct heir. So it's important when you have different situations, maybe it's a new grandchild, or you have a son or a daughter that gets married and they change their last name, or divorced, or whatever the case may be. It's just good practice and best practice to make sure that your plan is updated to whatever the situation is with your family, okay? This is very often, and that is when you get a change in your assets. Change in assets may be you just bought a new house. Or it may be that you've switched from one financial advisor to another financial advisor. It's important when those events occur that those assets are still properly titled correctly in your trust, or that the beneficiaries are identified properly, depending on the type of asset that it is. So it's always important to make sure that your trust is appropriately funded. It's very, very common for someone to come in and meet with one of us at the office, and they'll show us their trust, and we'll ask what is in the trust, and the response is nothing. Well, I just want to ask you the question: how valuable do you think a trust is that doesn't have anything in it? The answer is it's worth about the paper it's written on. So that's really important. We try to have people come in and meet with us at least every 3 years to make sure that their trust is current, no changes on their side, that the assets are all still funded properly, just to make sure that things go smoothly. Another common mistake is long-term care. I will say this is probably, if not the number one, the number two issue that my clients deal with right now. And this has to do with how do you plan, prepare, and pay for long-term care. There was a study recently that said that I believe it was 70% of Americans over the age of 65 will spend a significant amount of time in long-term care. Right now in Maricopa County, the average cost for a semi-private room is $7,000 a month, average. So it's very important, and there's some different ways to try and pay for long-term care. One, you use your own money, and if you have enough to do that, great. But that can get very expensive very quickly. Obviously, your condition and the care that you need will fluctuate on that cost. It's cheaper for long-term care, for example, in Prescott than it is in Phoenix, or it's cheaper in Tucson than it is in Phoenix. That just kind of varies with your location. But the cost is still very expensive regardless. The other option you have is you can use long-term care insurance. If you have long-term care insurance, don't let it go. Keep it, please. If you don't, it doesn't cost you anything to look into it and to find out. I'm not a financial advisor, but if you have one, you should talk to them about it. If not, let us know, and we can try to refer you to people that might be able to help you with that, to at least look at the possibility of long-term care insurance. Talk to your kids about long-term care insurance for their families. There's also qualifying for Medicaid and veterans aid and attendance benefits if you're a veteran. Unfortunately, those are both means-tested programs. And what that translates to is if you have the means, you're not going to qualify. And their definition of it is basically $2,000. If you have more than $2,000, you can't qualify. So you have to do what's called spend down. So it's very difficult to do that. It is possible depending on your scenario, but there are things you can do, but just something to really keep in mind. Here we're going to talk about some of the tax issues. This is the number 4 planning mistake. Everybody loves to talk about taxes, right? Death and taxes. That's what I get to talk about every day. So I have a lot of people that will move to the Southwest from other states. And those other states that they move from are typically what we call common law or separate property states. In the Southwest, especially in states like California, Nevada, Arizona, New Mexico, Texas, are what we call community property states. There's only 9 community property states in the country. Community property is much more beneficial for estate planning purposes than common law states. And I'll give you an example. If you were living in Minnesota or Illinois or New York or Michigan, and you're married and one of you passes away, you're able to do what's called a step up in basis for 50% of your assets. So whatever the value is, like say of a brokerage account, and you had stocks that grew in value, then you could raise the basis of those stocks for 50% of their value. So for example, let's say that you bought a share of Amazon stock way back when for $10 a share. And then over time, that stock went to $110 a share. You have a $100 long-term capital gain. When you sell that stock, the government says, hey, we get a piece of that. And depending on where you live, that is anywhere between 15% and up. So it's important to understand how that works. If you are in a common law state at death, you can raise that from $10, half of it you can raise up to the new basis, whatever the value was on the date of death. In a community property state, you get to raise 100% of that. So all of the assets can be raised to whatever the value is on the date of death. And then the second death, potentially you could do it again where you can raise 100% of it to the value so that your kids have very little, if any, capital gains tax, or your beneficiaries on the second death if you're a married couple. So if you had a plan created out of state, not in New Mexico or Arizona, very, very, very important that you get that plan updated. That alone could potentially save tens of thousands. I've seen it save hundreds and hundreds of thousands of dollars in capital gains taxes. All right. Now, I mentioned that the estate tax exemption right now is $11.58 million each. That law sunsets in 2025. So in about 4.5 years, it goes away. And it goes back to what it was before, which was $5 million. So that's a big drop. Well, we also have a presidential election this year. And in no way am I trying to be political, but it's important to understand that that could have a significant impact on your plan. And so you have to be prepared and understand that things can change. And potentially, it could drop well below $5 million, especially considering the amount of spending that the government has done recently for the stimulus plans because of COVID. They're going to be looking for ways to recoup some of that money. And then I would not be surprised at all for the estate tax to be one of those. So I would not be surprised to see that number not drop to 5, but even drop to $3 or $3.5 million. And then that starts to really affect a lot more people, because that includes the value of your home, the value of your retirement accounts, potentially life insurance, all of those things. Okay, so that was just an example. Now, you also have some states that have state estate tax. Now, this is in addition to the federal estate tax. So it's very important. And these are much lower numbers. So please, again, if you have, and we would not be surprised to see California jump into this mix again, because they have some significant financial situations there. But right now they do not have one. But you can see that there's several states that have a state estate tax in addition to the federal estate tax. So we talked about the Supreme Court case and Clark v. Raymaker is the name of the case, about okay, what can we do to handle that? Because right now, most of the time, we don't have the protection. If somebody just has what I call a probate avoidance trust, which is what the vast majority of trusts are out there that are designed to just avoid probate and then go outright distributions, you're not going to have any protection for these retirement accounts. Also understand what's the impact of that retirement account to your beneficiaries now that the Congress has passed this new Secure Act. And I will tell you, the Secure Act caught a lot of people off guard because there was a feeling that this really wouldn't get passed until after the election. But they swooped it in as part of the budget that was passed right before Christmas. And so it became effective at the beginning of the year. And it is a major, major change to how to plan for your retirement account. I would strongly recommend that you talk to your financial advisor and your accountant about potentially Rothing your IRA or starting to look at Roths. And it's just a math question, but it's something to really consider because of the impact of the Secure Act. Some of the ways that we're looking at to try and address that issue are using things called charitable remainder trusts, as I mentioned, Rothing your IRA, and then sometimes looking at a life insurance policy that could offset the cost of the income tax that they're going to lose. Because think about when those required minimum distributions come out to your beneficiaries, and let's just say it's your kids, it's going to be income on top of their income. So it often will bump them to a much higher tax bracket, therefore causing that to be taxed higher. And they'll often will pay 50% roughly when you add in state taxes. 50% of that IRA could be lost. So what can we do and how can we handle that? Well, there are options that we can talk about. Okay, so just important to really go into that. Again, just want to go out there. Does anybody have any questions? Anything you'd like me to talk more about as we go through that? By all means, we've got people here that are monitoring the chat line, the raising your hand. We can let you talk, or you can just type in questions. So feel free, if any of those, as I've talked about things, if any of those bring up questions that you might have. Now, here's the big one. We have cases where one spouse dies, and I'm going to use my wife and I as an example. If I passed away first, and a couple years later, my wife started to get lonely, and all of a sudden the pool boy comes along, and she sees this pool boy, and the pool boy, who's younger than her and has kids of his own, offers some companionship. And obviously I'm teasing, I don't mean to offend pool boys out there. But if she got remarried, the question immediately comes is to, well, what about our kids? My wife and I have 4 children and 1 incredibly adorable grandchild. What happens to them if all of a sudden there's now new kids in the picture? Because naturally that spouse, meaning my wife, would feel some type of obligation to her new spouse. And I will tell you, you would be shocked at how often what we have created, my wife and I, for our children often end up with the pool boy's kids. I see it far, far, far too often. So it's important to talk about that, plan for it. What can we do to protect it? For example, I can even put in provisions that say if the surviving spouse gets remarried, they have to sign a prenup. And so there's a lot of different things that we can do in an estate plan that can try to address some of these issues. And we don't know of all these issues what you, your spouse, or your beneficiaries might face. So we try to cover as many as possible. And that's the benefit of being a member of what's called the American Academy of Estate Planning Attorneys. And we are one of the charter members of that organization, but it's an elite estate planning organization across the country. And in Arizona, there are only 3 firms authorized by the Academy. And I believe in New Mexico, I think there's only 1. So, which is us. So, you know, it's a very, very important organization that helps us to make sure our plans are very, very effective. You have to think about blended families. And again, I'm not saying remarriage is bad, and I'm not saying a blended family is bad. Very, very common. But it's just important to talk about and understand the impact of those, you know, what's going to happen when one person dies, and what's going to happen to the kids of the other spouse. So very important considerations. As we talked about, this could be the pool boy, but often it's usually somebody much younger. So we want to be careful. Now let's talk about your beneficiaries. And I'm going to use, again, my family as an example. We have 2 kids that are still at home and 2 kids that are married. And my daughter, my oldest daughter, got married about almost 2 years ago. And she's always had me wrapped around her finger her entire life. And I can tell you that we love our son-in-law, but you have that feeling as a parent that you want to make sure that she's taken care of and that she's protected. Well, how would you feel if you worked so hard and you left something to your child only to see them get divorced because their spouse turned into a jerk or whatever, and to see that spouse walk off with half of whatever you left them? It happens every single day. It's critical and very important to think about that and to understand. We had another case where a child claimed bankruptcy 2 weeks before mom passed away. The bankruptcy trustee tried to not only go after his inheritance, but also the inheritance of his 2 siblings. But because of the plan we created, they weren't able to touch not only the siblings, but they couldn't touch a penny of what the person that claimed bankruptcy even was inheriting. So there's just a lot of things that we can do. Financial immaturity is another example. How old will your beneficiaries be when they're capable enough to manage those funds? And that's different for every single family. But you know, sometimes I have clients that are leaving things to grandkids, and they're young enough where sometimes you don't know yet what's going to happen. So a number of very, very important factors to consider. Another one that's very important that is coming into play a lot right now are your healthcare documents. There's 4 main healthcare documents that you should have, and they should be current, and they should be applicable to the state that you have. And when I say current, I mean they should be fairly recent. You don't want old healthcare documents that hospitals or doctors may be concerned about because they are stale. Something that was drafted 20 years ago, is this still really what the person's beliefs are and feelings are? So strongly consider those. But the 4 healthcare documents are your living will, which are end-of-life directives as to how you want, when the time comes, do you want to be kept comfortable? Do you want to be kept on machines? No right or wrong. It's purely your choice and your decision. But it's very important that people know what that is and that they understand. Your healthcare power of attorney. Who is that healthcare power of attorney? What powers do they have in decision-making for you? Do you want to give them the ability, if they have a concern, to request an autopsy? Do you want to be buried or do you want to be cremated? They have to know, and they have to have authority, because now the funeral home will ask them for some type of documentation that gives them the authority to decide, are you going to be cremated or are you going to be buried in a coffin? So very important. One of the most important now, though, is called the mental health care power of attorney. And that's with the rise of dementia cases and Alzheimer's cases. that it's very important. You don't want to have to go to court. Least favorite part of my job is when I have to go to court and I have to prove to a judge in front of the individual and their family that this person has lost capacity. That is not something I enjoy. That is not something that I want to do. And I'm speaking from personal experience. But if you have a properly drafted mental health care power of attorney, we can avoid the vast majority of the time where your loved ones can have the power to get you in front of the right people, to get you the care and treatment and protection that you need. So please, please understand how important those documents are and how important it is to make sure that they're updated. Finally, have you really talked to your family about what their responsibilities are? What's going to happen? Some people don't like to talk about money with their kids, and that's okay. You don't have to do that. But you should at least tell them that there is a plan. Where do they find things? Who should they call and talk to? I often will have clients where we'll set up, where if they have family in town, they'll bring them in, or we'll set up a Zoom call where we can get family members from across the country on. And I just have to ask the clients, okay, what don't you want me to talk about? But then I go over and talk about how their plan is crafted, how it works. When does this certain phase kick in? So really it helps tremendously when family members know their roles. So that, for example, one family member isn't going to get upset because another one was assigned a certain task. You can always blame those things on us because we give you the direction. And it's easier if they know up front. We can talk to them and say, look, this is why we gave this direction. So again, something very, very important to talk about. And this is just an example of those family meetings that we talked about. Another thing that is becoming very, very, and I strongly encourage you to do this, is one of two things. Either record a video about your life. You would be amazed at the changes in what beneficiaries want to have and to know. Nowadays, I can tell you, if you talk to someone that does estate sales, and trust me, we deal with it every day, you cannot give away china. You can hardly give away silverware. But what people do want is they want to know about you and your family, where they came from. And I don't know if this is the rise of these DNA websites, the ancestries.com and things like that, but there definitely has been an increase, a significant increase in kids wanting to know about not just mom and dad, but grandma and grandpa, and great grandma and grandpa, and things like that. So I would strongly encourage you to do that. Now you think about this and these mistakes, there's got to be a better way to do it. So I'm going to talk to you a little bit about what's called a legacy preservation trust. And we're going to go over some of the options. This is just an example of the Jones family, okay? And first of all, you create the trust and you have joint property. And sometimes you have the wife's property and the husband's property, because sometimes you have separate assets. You put it all in the trust. In the trust, you have the trustors. They're the ones that create the trust. So then in this example, that would be Bill and Mary. You have trustees. Right now, that would be Bill and Mary as well. They can do whatever they want with it. And then you have the beneficiaries, and that would be the kids. So here's an example. Bill and Mary, they're going 50-50 to their two kids. Well, if you look, the two kids don't necessarily look the same. And I know you shouldn't judge a book by its cover, but we're trying to do this on purpose so that you can see that a lot of times in families, you've got some kids that are very responsible, and then you have other kids that you might worry about a little bit more. So what we do is on the second death, we don't just write a check to the kids. We strongly recommend what's called an asset protection or a beneficiary trust for your kids. And Arizona specifically allows some very significant protections And it's not punitive. So for example, Susan, if she's okay, she can manage her own assets, but John, maybe he's not. So maybe you need a third party to manage assets for him. And in that, they can do whatever they want. So if they have this asset protection, this beneficiary trust, they can go open accounts at wherever they want, Schwab or TD Ameritrade or wherever. They could go buy a house in the name of their beneficiary trust. They could buy investment properties. They can do whatever they want. They can take money out and go buy a car or go on vacation. They can't just put money back in. It's like toothpaste. It goes out of the tube, but doesn't come back in. And then if the kids were able to, passed, and when they passed, they still had money left in their trust, it can drop down to their children with some of the same protections. So very, very important aspect of estate planning. Also, you want to be careful that if you have a potential beneficiary, whether it's a child, a grandchild that has special needs, you do not want to have any unintended consequences. And if you leave money to that child in the wrong way, you could unintentionally disqualify them for very important government benefits. So please keep that in mind. You need what is called a special needs trust or a beneficiary trust with special needs protections. Okay. We talked about the IRA and the beneficiary trusts that we have with a legacy wealth trust, specifically designed to minimize the taxes that a beneficiary would pay. And I'm going to give you an example. Some of you may have remembered the phrase that you hear in the news a lot, that the rich need to pay their fair share. And again, not trying to be political, just stating specific publicly made comments often. Well, sometimes that was defined in legislation as someone that has a trust, and specifically the types of trust that we're talking about for your kids. So you and I would reach the highest tax bracket for income taxes at about $450,000 to $500,000 a year. And then after that, everything above is at the highest rate, right? Well, a trust can reach that highest tax bracket at $12,500 a year of income. So what we try to do is we try to make sure that whatever income is coming is going to come out and be taxed at the individual rate. Sometimes there are reasons why we don't want to do that. Again, it's kind of a case-by-case scenario, but it's important to understand. You often will get people come in and say, oh, what we have is simple. Well, once you understand a lot of the ramifications, the tax laws, the protection that you want for your loved ones, it unfortunately becomes more complicated. But just know there are options out there and there are things to do to try and protect things. So as we go back and we talk about the 8 mistakes, know that there are things that we can do to make sure that those things are covered, that are taken care of, and that there are protections, okay? But that doesn't mean that that's what everybody needs and everybody wants. So I want to kind of lay down some of the different options. The first thing that you can do, minimum, is have a last will and testament, power of attorney, so that's like a financial power of attorney, a healthcare power of attorney, a living will, and a mental health care power of attorney. And then also in addition to that is a HIPAA. That's the bare minimum that you need. The plus of that is it's cheaper up front, but it's more expensive on the back end when you have to go to probate. More expensive, it's public. Anybody that's been through probate, I've never known anybody who said they enjoyed the process. So that's the minimum. The next step would be having those same documents, the will, the power of attorney, the healthcare documents, and what we call a probate avoidance trust. So the probate avoidance trust will do just that. You put your assets in the trust, it will avoid probate. It still has to go through what's called estate settlement or trust administration, but it's much better than probate. At the end, it's distributed out, an outright distribution, like I said, writing a check. So this is kind of the middle ground. And then finally is what will address all of those 8 deadly mistakes that we talked about. And that includes the will, the healthcare documents, probate avoidance, but also all of the protections for the surviving spouse, all of the protections for your kids from divorce, from creditors, from bankruptcy, and from taxes, from income taxes, capital gains taxes, and to help minimize estate taxes. So again, doesn't mean that they won't have to pay any of these taxes, but we try to minimize them to the greatest degree as possible. So everybody's in a different scenario. I just like to lay out all the options that you have and let you decide which one's the most appropriate for you. And then you look here, and this is